Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. For Mark Friedman, the founder and CIO of DLD Asset Management, the convertible bond market has always made for interesting study. Sitting at the intersection of critical asset classes, the convert requires investors to assess risk from many dimensions at once. And with valuation components derived from equity, interest rate, credit, and volatility risk, converts have provided Mark with plenty to analyze over nearly 3 decades in markets. Our conversation is a retrospective on the evolution of this hybrid product, from Mark's early days trading Asian convertibles in the mid-90s to the high-vol, crowded era of the early 2000s all the way to today. Along the way in our discussion, we happen upon some of the important risk events in converts that Mark has traded through. He highlights some of the ancillary risks that an investor assumes, specifically borrow, dividends, and a vol dampening takeover, and how the market has sought to address these over time. We also spend some time assessing the changing buyer base in converts, from a market once dominated by arbitrage accounts to one in which long-only capital has become a greater proportion. Lastly, we discuss portfolio construction in a world of low rates, active central banks, and risks that originate from sources not previously contemplated. In this context, Mark shares his thoughts on tail hedging, recognizing both its value and its cost, and preferring to keep it simple using listed options. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Mark Friedman. My guest today on the Alpha Exchange is Mark Friedman. He's the founder and the CIO of DLD Asset Management, a hedge fund here in New York. Mark, it's great to have you on the Alpha Exchange.
Oh, great to be here.
Excellent. I'm glad we're having a chance to catch up. We are at the back end of the GameStop week, quite a week. So we'll circle back to that at the back end of our conversation and get some of your perspectives on just the insanity of volatility that we've seen. But you've been at this for quite some time, so you're no stranger to vol events, and you're no stranger to very sleepy markets too. We've experienced plenty of those as well. I'd love for you to start our conversation just with your thoughts on how you got started in finance. What was it that attracted you to the field of finance? Tell us about the early days and how you wound up on Wall Street.
Sure. When I was graduating college, it was really, I've been doing this for almost 30 years. And I think that, at least in my perspective, kids today are much more focused on what they want to do with their lives as they're coming out of college or what they want to try first thing. I was really open to doing anything, despite the fact that I was getting a business degree. And I was very, very fortunate. I wound up getting a job at a firm called OConnor and Associates. It was one of the luckiest things that ever happened to me. This place was a place that really taught you about math, and it taught you about distributions, and it taught you about option theory. But more than that, it was incredibly fun. It was a whole bunch of really smart people that always pushed you. And we were standing on the floor of the American Stock Exchange, where it looked like you were in the Trading Places movie. Everyone was yelling and screaming all the time. So it really was a fantastic way to get started.
Tell us a little bit more about OConnor. So there's, of course, a very storied reputation for this firm, and its philosophy seems to live and breathe in markets today. Just a philosophy in some ways of, like you said, distributions and relative prices. Talk to us a little bit more about the training program there, your early experiences there. That'd be great to learn more about that.
What happened with OConnor is really a snapshot of what's happening across the entire financial markets. When you went there, you were basically taught that you did not need to understand anything fundamental in the markets. I started in the equity division, but if you were trading FX or bonds or and derivatives on those securities, you didn't actually even need to know the underlying. That all you needed to know was the math. It was really a fascinating approach. These were the days where we didn't even have palm-top computers to go stand in the crowd and yell. We printed our sheets of theoretical values in the morning, and we read off those sheets as the stocks ticked. But my math was better than everybody else's math. That was my competitive edge. And I think sometimes I mention this to people and they kind of giggle. Like, your Black-Scholes model was more efficient than other people's. Your vol assumption was more efficient than other people's. And it really was the truth. The dislocations were such that I didn't really need to understand anything about the underlying companies. It's really come full circle. That knowledge that I had at OConnor is probably the most important piece of risk control that I can use in our business today. Understanding the idea that markets can stay irrational longer than you can stay solvent, and understanding how tails work, and understanding all the things that you would learn fundamentally from an options or convertible bond trading book. But in order to really turn that into money, into profit for your investors, you need to add other disciplines now. I think unless you are one of the big, and you would know them better than me, but big 5 or 10 shops that have really spent tons of money on infrastructure and are going to try to trade, I don't know, Apple options for 0.2 vol points of edge. If you're not one of those, you really can't rely on your math, because the math has been democratized.
So you got your start a while ago, before a lot of the revolution in technology, in the front end of trading technology in terms of instant access to options markets. But you've been a presence in the convert market for many, many years. In a lot of ways, this sits at the center of so many other asset classes: vol, rates, credit. Pretty fascinating product that itself has gone through just different cycles. Love for you to just walk through some of the earlier parts of your career. So you're at OConnor. What was the next stop? So walk us through the point through which you wound up striking out on your own and founding your own hedge fund.
Sure. So the first lucky thing was I wound up at OConnor. And then the second lucky thing that happened was the Swiss Bank Corporation, SBC, bought OConnor. And they took me overseas. I spent 3 years mostly in London, but I spent some time in Southeast Asia, Hong Kong, and other parts, trading all sorts of derivative product. I traded Southeast Asian converts during the first Thai baht crisis in 1997 and the Asian contagion. I was trading Japanese derivatives and the Japanese warrants when Nick Leeson blew up Barings in 1994. And you learn incredible things from those types of events, and particularly in markets that are outside the US, and the ones that are developing. So obviously, the Southeast Asian ex-Japan convertible market in 1997 was far from what the US convertible market is today. The rules were different. There was a lot of, backroom dealing, as boards were made up of brothers and sister-in-laws and all sorts of things that you really shouldn't see and you wouldn't see in a place where there's an SEC. You really learn that there are risks that you can't just see on the model on using the math. And that was sort of like my first entree into understanding that, you need perspective here. You need to put everything into its place. I moved over to Deutsche Bank in London, and I wound up coming back with them to run Deutsche's U.S. convertible operation. And this is the late 90s, and hedge funds are really starting to come into their own, but the convertible business is still dominated by the outright player at this point. So the long-only investor, equity income investor. And the ARBs that were there were really there to capture the flow that was created by, we'll make it up, TCW or Fidelity or Allianz, as they bought or sold securities. That all changed, and we can get into that, as ARBs really dominated in the mid-2000s, and then we've come full circle to where we are today. But I ran Deutsche's desk, and this was also a time of very large proprietary positioning at banks. It wasn't just us at Deutsche Bank, but it was Goldman and Morgan and Bank of America and Merrill Lynch, all held very large convertible bond positions. And then in 2001, I struck out with a partner. We formed AM Investment Partners, and we launched as a convertible ARB shop and grew that firm up over the years. And really, that was the beginning of truly understanding some of the relative value space that I had been living in since I joined OConnor in the early days on the floor.
I'm remembering back because I can remember some trades that we did back probably in the early 2000s, and two of them really stand out. And you guys were always good at just having the capacity to look at a number of different, sometimes off the run type trades. But there was one, you'll recall, Mark, when Microsoft struck out a deal to effectively help their employees monetize their employee stock options. And little did they know how successful this plan was going to be. And the bank that effectively took down the trade, and I want to say it was JP Morgan, wound up owning more Vega and Microsoft than they could have imagined. And so on came the onslaught of selling pressure in Microsoft vol. And I want to say we did something where you bought Microsoft variance below S&P variance as a spread trade. I don't know if you recall that. Pretty interesting one.
Yeah, I vaguely do recall that. And that's sort of what I mean about that today's world. Like, at least for us, it's very difficult for me to think about, hey, can I buy Microsoft vol cheap and realize it? Right? Like, you need something to point to. And in that case, it was, well, you had a technical pressure. But it just as likely could be, hey, there's an event that's going to occur, so the distribution is distinctly non-normal, even though the options are using a normal distribution to price the security. But that goes to exactly what I was trying to get.
As you think through the early 2000s, so you'd mentioned that the convertible market had gotten bigger. It was a time of strong issuance. It was a time for very high volatility levels in markets as well, coming off the tech bubble before September 11th. So there was a lot of volatility in the market. Tell us about the convert market there. And it would even be helpful because I think our listeners benefit from perspective through different risk events from folks like you, but also just trying to understand products that they may not look at each day. So I'm curious if you can kind of package this up for us, the convert market in the early 2000s, what it was like, who the constituents were, what were the trades that folks were looking to capitalize on. Of course, with converts, you have an issuer, which is very different from equity derivatives. I'd love for you to just give us some color as you think back. It's a while ago now, but if you think back to the early 2000s in the convert market, what can you tell us about the goings on at that point in time?
Yeah, the convert market, I think, is really a unique beast. And in its heyday, it made up, a good 20-25% of a lot of underlying alternative portfolios. So the neat part about convertibles, obviously, is that it's part bond and it's part equity option. And so there are lots of different types of dislocations to take advantage of and different ways to approach that. So you have people doing convert arb that are clandestinely long the credit market or clandestinely long the equity market by how they hedge, or short for that matter. Or you can play it true straight down the middle and hedge your equity or hedge your credit. So there's lots of pieces to break it up. It sits really at the center of so many different flows. And what's amazing to me after being in this market for over 25 years is that it hasn't gotten any more organized in a lot of ways. You'd think there would be a better way for someone to arb what's going on in rates, what's going on in credit, what's going on in equity derivatives, and what's going on in converts and high yield. So like you have all these pieces, or the fixed income markets. So you have all these pieces that are moving around that allow you to sort of pick and choose how you want to structure your trade. In the early 2000s, hedge funds were really starting to come on, and converts was a big place for them to focus. It's intra-capital structure arbitrage, so it's a lot different than the idea of being long Microsoft and short Intel. It's all within the same capital structure, which has its own attraction because it limits some of those tails that you might find in a traditional long-short strategy because you can lose money on both sides. And because you have many different players in the convert market, whether it's equity income players, outright benchmark investors, high yield folks who receive the convert from a restructuring, vol players, pure convert arb, there are always dislocations that occur. The biggest change as money ramped up, I traded through a number of different bumps in the road. So you certainly had 9/11, and you had the dot-com crisis. And then obviously we can talk about the global financial crisis. But the most difficult market that I remember trading through was, say, 2005, because at that point, the convertible hedge funds probably controlled 70 or 75% of the convertible market. So insert the brand name hedge fund that you want, they were trading with each other. And I'm sure everyone who was a PM at those shops thought they were the best and the brightest, and that's okay that the other guy is trying to do the same thing as me. But really, that's not what, in our eyes, a hedge fund is supposed to be. A hedge fund is supposed to be taking advantage of dislocations. Dislocations that can occur for any variety of reasons. Either the fact that Convert sits at that nexus of all those different markets that we talked about, or the fact that an outright buyer or seller is creating a temporary dislocation, or a crisis is creating a market-wide disruption. And you're supposed to be able to take advantage of those mispricings and capture them for your investors. And where in 2005, it was really, there was a lack of disruption, I guess is the best way to say it. The good thing that came out of that, there were a lot more protections added in convertible bonds that had not been there previously. You suddenly had very large household name issuers coming to the U.S. convert market. And because the arbitrageurs dominated, we demanded protections so that we could not have these big events that caused big drawdowns. So I think Amgen brought a $5 billion convertible. And I remember it as being one of the first bonds that had takeover protection. So that's something you don't necessarily get in the equity derivative market. But now this is completely standard across the convertible market. The takeover protections in the convert market are there to compensate you if your option should go away early due to an M&A event. Now, it may not always be enough, but it's something so that you're not going to walk in and have to call your investors and say, well, we have a real problem here. So those types of things, there were dividend protections were added, even some of them even had stock borrow facilities and things in it. So really catering to the ARB. And then you fast forward to now, and despite the fact that ARBs are not the dominant folks in that market, all those protections still exist. And it really sets up a neat dynamic that, wait a minute, stuff isn't stretched, it isn't trading ARB to ARB, there are massive dislocations, and you're going to give me all these protections that were put in place 15 years ago. It lines up, certainly relative to some of the other spaces quite attractively.
Well, you mentioned those protections. So takeover, divs, and borrow, those are three very important protections. I'm curious if you'll recall when those were being put into markets, were they priced? In other words, were folks willing to step up with more capital and be more aggressive because they were more comfortable on things like takeover protection, or did it just become a nice to have and people moved on?
Definitely folks were able to buy larger positions. It really came from some of the larger hedge funds at that time that were associated with convertibles, like a Highbridge. And they would go to the underwriters, and you could look at their filings and see, well, they own $400 or $500 million worth of one security. And I'm sure I could imagine the conversation. Well, you can't take away my 30% premium over a takeover in one transaction. Or if you do, I can only buy $75 million worth of the security. So if you want to bring a $5 billion bond where ARBs make up 75% of the market, you need me to buy $400 or $500 million worth of this thing. And the only way I can do that is to make sure that I'm protected, that you don't take all my premium away in one day.
In terms of the collaboration that someone like you, a convertible arbitrage investor, would benefit from in terms of coverage on the sell side, how much coordination could you expect, or would you expect, or did you get from, let's say, a derivatives desk and the converts desk that operates alongside it? Were they especially siloed? Were there opportunities you thought to bring those two products together? Obviously, they're related, but how would someone like you look at the bank's delivery of the cross products?
So the sell side really was the mecca to begin with. When I was at Deutsche or Swiss Bank, there was tremendous opportunity to leverage the tools within the bank to create a more efficient book within the bank. So I spent a lot of time, we were based on the equity floor, and the convert folks sat right next to the derivative folks, who I actually were populated with a bunch of OConnor guys that I knew, so that was easy. But I spent a lot of time obviously talking with them, talking term structure and corporate flows, which you know quite a bit about, and trying to understand where long dated should trade, even if there's only 6 months or 9 months of options. And then equally a large amount of time on the fixed income floor, where I was talking with the credit guys and trying to understand, can we repackage these convertibles and sell off the equity piece, sell off the fixed income piece and isolate that equity option and break this up to its truest value. This is a giant change post-global financial crisis. So the banks were the training grounds for great arbitrageurs. So we ran a large book, like I said, Goldman, everyone, and post the global financial crisis, with all the change in regulation, you don't see that. So the banks are still filled with very talented people, but the skills that they are developing are much different than the skills that were developed during my time there. Right? The skills are much more a sales and trading skill, a delivery of information in an efficient manner. You don't see, just for the fact that the risk budgets are not there because you have Dodd-Frank and you have all the other regulations that say that, well, the banks can't run a $4.5 billion prop book. They can run $75 to $100 million in customer facilitation positions that have to turn over every 30 days. So just by that nature, and that, by the way, is one of the great opportunities in converts right now. You have a market that probably has sub 10% of the arbitrage assets or arbitrageurs that existed pre-financial crisis. And then you probably took out $40 or $45 billion worth of prop desk buying power from the banks, even if those prop desks were really Sellside desks that were buying them. And what it's created is this giant vacuum when the outright community, who now dominate the flows, comes to buy or sell a security. It can create dislocations in one day that you may have not seen over your entire career just by those flows, because there's no buffers. Goldman Sachs can no longer decide, well, XYZ outright client is selling this bond. It's really cheap here. I'm going to buy it for myself. That is not a decision that they can undertake. And so the pendulum swings so very quickly, and that's a liquidity issue, a supply-demand issue, but really it's a giant opportunity for anybody looking to take advantage of it.
So you have some really interesting perspective, having grown up inside a large sell-side organization and done some structuring that brings rates and the credit component and vol component of converts and sometimes disentangles them to strip out different products. And so now running your own firm, I'm wondering if you kind of look at let's say the characteristics of a salesperson. I know the job has changed over time for sure, but over the entirety of your career, I'm hoping you can give us some broad perspectives on the characteristics of a salesperson that covered you effectively. Where was the value add when it was really working? Was it product knowledge? Was it just hustle? Was it collaboration internally with that person's trading desk? Where did you find value in the coverage relationship? What did the characteristics of that person look like?
There's definitely some definable traits to an effective salesperson. So first and foremost is to bring something to your attention that you may not have noticed. And it's some degree today, it's a bit of a lost art. There are a handful of people. And by doing that, the salesperson doesn't need to have all the answers. It could be a large piece of flow. It could be an article that they're reading. It could be a piece of research. Whatever it is that can set you down a path that you may not have walked on previously. To me, that's the biggest thing. Because as I mentioned earlier, we can screen for things and look for things that the computer might want to tell us. But the biggest edge that we're going to find is when we combine disciplines, right? We combine let me hear about the fundamental story or potential underlying event and combine it with what we understand in the math world. I'll often joke when we're on pitches, I'm like, you don't understand, as simple as that sounds, that it's really a lost art. And the reason is, if you walk into a bulge bracket bank right now, the research folks sit on the 9th floor and the quants sit on the 4th floor. And that sounds ridiculous in this day of interconnectivity, but it's really the truth. So the first thing is can you show me something, even if it's not well thought out, that perhaps I have not seen, or flag the importance if I have seen it. The next is really persistency. You need someone who is going to pick up the phone, who is going to call you, who's going to want to talk market so that you understand whether it's in the inflection of their voice, and I'm definitely painting myself old school here, but in the inflection of their voice or in the tone or something that's saying, no, actually, I should be really listening here. This is something that we might be able to do something with. The biggest change from, say, the days when you and I were speaking so regularly versus someone now at a bulge bracket who covers me is there are only a handful of people who pick up the telephone. Most people are absolutely see fit to cover us, over tech, over chat, or over email, and which is fine. It's nowhere near as effective. So persistency, bringing something to our attention, and then hustle is so important. You can cross-sell it. On the convert side, we have some folks who are not big underwriters that are in our top 3 of execution because they just are hustlers and they'll just get it done time and again.
Yeah, I always remember from back in the day, Deutsche had not a huge capital markets presence, but had a huge hedge fund franchise. And to me, it spoke to just hustle from the sell side and then just good collaboration between sales and trading. I think that's part of what keeps a client coming back is a sense of consistency, which really is a function of sales and trading working together. I wanted to ask you a couple of questions just on the setup then versus now in terms of the components of pricing and sort of how you think about hedging a convertible portfolio. So rates, let's start with that. It's the early 2000s. Vol was high for sure, but you had a 5+% 10-year. That was something that moved around. Now we're stuck around zero, certainly in funds and out to a couple of years on the treasury curve. And even the 10-year, you've got very, very low rate vol and pretty low rates. And so I can imagine we step back and look at a book of risk that's sourced through convertible paper. The rate side is quite a bit different now versus then. I was hoping you can talk to us about that. How does that change over time just based on the rate environment, the rate volatility environment? What's it like now versus then?
I think the biggest change for us, and you point out the glaring macro pieces, that rates are zero and rates were not zero back then, is where we tend to live in the curve, both in tenor and in delta. Our book is very high delta and very short duration. So our credit 01 or our DV01 is very, very small. It would be much more similar to an options book in a lot of ways because we're far away from our fixed income value, if you will. So if that were to move because the 10-year goes from 110 to 1.25, it's not going to change the value of our securities all that much. But I think back then we had many more securities that had some length to them, had some duration to them. And I guess we probably shouldn't have hedged the interest rate exposure. But it sounds kind of backwards. Yeah, we're hedging it at 5, we're not hedging it at 1, but we did. We hedged it on some type of percentage basis. We tried to figure out, whatever we thought was clever. We'd look at a regression and see how it moved with rates over time, not just to take a DV01 number, things that seemed smart at the time, but I think you probably would have been better off just letting that one run.
Fascinating. So let's talk about DLD. So this is your current fund. You founded it, am I right, in 2013?
I did, yeah. So DLD is named for my 3 children. I have a Dylan, a Delilah, and a Lena. And when we were launching, I would make some type of joke about who was behaving would be the first D, and who was not would be the last D. But now they're a lot bigger, so the joke doesn't fly quite as well. So the idea behind DLD is we've created sort of a deconstructed multi-strategy fund. We have a number of relative value arbitrage type strategies that tend to be long convexity and make money when things are going crazy and hopefully make money when they're not. A real focus on old school hedge fund. Again, we've seen the hedge fund, and you've seen it as much as me. The hedge fund world has really morphed. Not to pick on the long short folks, but you've seen a large number of long short people have a very hard time competing with the market. And from our perspective, a hedge fund is supposed to have the opportunity to make money every month, every quarter, every year. Doesn't mean you always will, but it's because you're trying to pull out some type of mispricing that exists. And we talked about some of the reasons earlier why those might exist. And that's what we have. We have 4 different strategies in the room. The strategies are all capitalized at their individual level, and then they cross-pollinate each other. So our convert guys will clearly work with the merger team or with the options team or with the equity trading team and try to maximize the knowledge base in the room. And then on top of that, we're really layering in bespoke custom mandates as the investment community has gotten much more specific to their needs that can help people's portfolios. So we may have somebody come in and say, can you give me these three and you decide what allocation to them? Or can you give me those two and then put them in a custom for me? And we think that's really the way forward. It would be a lot easier if I could just say, hey, I'm going to launch one fund and everybody put their money in it. But this is the way we built the business, and we think it serves us well. I'm also working with people that I've known for a very, very long time in one shape or form. So being surrounded by experienced people you like the value of that can't be overstated.
We're sitting here in the early part of 2021. A bunch has happened already. But of course, 2020 is just an unbelievable year in so many ways, so negatively impactful to the country and economy. Markets became unbelievably volatile in March. And then the cleanup program of the Fed and the government with a lot of fiscal response. How has the pandemic, what was the period, let's say in April and May of last year, what was that like to trade through? Any big lessons or things you can share in terms of market action or opportunities that you saw during that period of time?
First of all, the human toll. I know we're not here to talk about that, but it's just shocking to think about. When we write our letters, I always maybe make a quick reference to it and then say that I'm just not equipped to address that. So we stick to the finance. We built a business that is principally long convexity. So it was a very interesting time as the markets began to unhinge and see that our products were doing hopefully what we wanted them to be doing. But the immediate lesson in the aftermath, it so reminded me of 2008 and 2009 was, I kept thinking, fool me once. The Fed's function has changed and its reaction time has greatly changed. And the tolerance for an equity market to do what it did in March is almost none. I often say that although OConnor was the best place to learn about trading derivatives, there's one thing they taught me that I wish they didn't. They taught me that stocks had a normal distribution around spot. And that is clearly not true. It may have not been true in 1992 when I started, but it is absolutely true right now. The distribution, if you were to draw it, is skewed to the upside. And that's largely because, and the tail is probably skewed to the upside too. There is a left tail, but it gets very, very skinny very, very quickly. It doesn't mean you can't hit it because the Fed has assumed this position and that the stock market has become an important part of either the perception or reality of the economy.
Amazing. We always were taught that markets crash down, not up, and we've seen quite the opposite in a lot of ways, at least post-pandemic. And as you said, the Fed has taken on a new role. Some say it's the third mandate of you've got growth and inflation as the first two, full employment, and then, of course, something to the tune of financial market functioning, cutting off that left tail. The Fed's reaction was so bold. They crossed the Rubicon. They bought high-yield bonds. They indicated that they would do more. And so it's created some really interesting dynamics between credit markets and equity markets. Perhaps equity markets are a beneficiary of all the stuff that's going on, but they remain very volatile even as credit spreads have tightened. So you've done a lot of stuff on the capital structure side of things. What does the world look like to you when you look at a capital structure of a company, you look at its debt and the pricing of its debt, and then you look at the equity side? What's that like right now, post-pandemic, versus perhaps where we were at the end of 2019, before the pandemic?
That is the question, right? So for us, there's a reason why our book looks much more equity volatility-like than credit-like at this point. To your point, the Fed physically bought credit. They bought credit ETFs. They were involved in every way, shape, or form. So now, if you can take that credit piece out of the convertible, you're left with a very, very cheap option. And so sometimes that gets lost on people. We had a position pre-pandemic in Tesla. And in Tesla was everybody's favorite name to trade, right? It's perhaps, I don't know, one of the top 10 most popular companies on the planet. People certainly love to talk about it. And if you picked apart the capital structure, you could create optionality that was 25 vol points below listed market. 25 vol points. And that was pre the Fed getting involved. That was in February. Post, it's the same type of thing. You'll see that the credit portion is trading irrationally compared to where the volatility portion is trading, and you'll be able to replicate it or create it so much under where you're seeing it in the listed market. It's really fascinating. The thing that really shocked us when the pandemic first hit was that the liquidity crisis that had been like a slow-moving train wreck during the '08 time, it happened so quickly. To see cash future basis trades blow out tenfold or merger arb spreads blow out eightfold from where they were, it's just not something that you would expect to see over any stretch, but certainly not over 30 days. And so I think for that reason, and I don't know the exact cause, but for that reason, that's why it's really become a big piece of the Fed's mandate to make sure that it does not break down.
Let's go back to Tesla, because this is something I've been noodling over. I would really love to get your take here. So this is a, $800-ish billion market cap company. The vol is tremendous. I mean, this is a 75 implied vol name, $1 trillion company nearly with the 75 implied vol, but not 1 month vol. You can go all the way out to 2 or 3 years. I was saying Elon Musk could do a zero cost collar on Tesla. It'd be obviously the biggest trade the market's ever seen, and lock in wealth at something like 140 billion and still have 40 or 50% upside left in the stock. So it's a beast. That long dated vol is so high. And yet you've got, I believe it's a split rated company. It's like B2, BB. And yet the market cap is $800 billion. How do you square all those things? It sounds like you have, just with some of the stuff you've done creatively. But I just love to get your take on it. It's a fascinating commingling of prices.
So I'm certainly not a Tesla expert, but what I will say is it sort of goes, putting things in perspective is the greatest skill. So to be able to say, I'm stepping back and Tesla could be, the technology could be, and it's that combination, again, the story, the fundamental, with the math, whether it's the financials or the volatility. And that's what really, in my opinion, drives stocks like that to valuations where they trade and to options pricing, right? Because suddenly the unimaginable happens very, very quickly. The changes that you and I saw early in our career moved at a snail's pace relative to what happens now. So is it unreasonable if a 25-year-old analyst comes in and tells you, well, hey, actually, Tesla is going to put people on Mars in 12 years, right? Does that wind up in somebody's model? And then your distribution just gets so much wider, not to mention all the stuff that just went on with like a Robinhood or a retail craze because it's something people understand and they like Elon and all those types of things. But this whole idea that if you can imagine it, it can change, it can happen. It's not, at least certainly was not how I was brought up, right? You sort of came into the system and this is how the system functions. Now, when you bring younger people in, it's like, wait, why is this the system? And so I think you see that in the evaluation, both financially and otherwise in companies like that. And it does keep the volatility. You're absolutely right. If someone would tell you I have $1 trillion company on a 75 vol, 3-year vol trade 75, you would be very surprised. And that's where we live.
I think once you untether yourself from any valuation framework, you could put Bitcoin in that category. The sky's the limit, and upside parts of the vol curve become worth, possibly justifiably so, quite a bit. We've touched on a bunch of themes here, and I've got 2 areas I would love to explore as we round out this conversation, and I want to thank you for the time. The first is, just in light of the hyper-competitive markets in which we find ourselves, we're all benefiting from technology, but it's also deflationary in a lot of ways, right? Things react very quickly. It's hard to find edge in the market, perhaps versus the 90s in the convert market? Things have changed from an efficiency standpoint. And we've seen, as we talked about with things like the financial crisis, you mentioned the Thai baht crisis, and then, of course, this week with GameStop, finance is a never say never endeavor. Just when you thought you'd seen it all, it's just we see things that we just wouldn't have thought could occur. And so as you put your portfolio together and you have commitments to your investors about delivering return, but trying to do so in a safe manner, what are the landmines that someone like you and your team are especially trying to avoid? What are the blind spots that you are asking yourself, are we overexposed to something? What might we be missing? What's that like in this environment in terms of balancing risk and return?
Well, I guess I'll say that the convert market specifically, but even across the other pieces, is to make sure that if you're long convexity or what you're trying to build, that it's really there. So the convert market is an interesting beast in that at some point in a down move in the equity market, you'll get a perceived credit deterioration. And so you go from potentially long gamma to what feels more like a short gamma position, right? Your fixed income value is going down so rapidly that it's like your put strike is moving away from you and you're needing to re-hedge the wrong direction as the stocks fall. So that's something that we are very, very focused on. The idea that should you get a fourth quarter '08 type sell-off, which I think is probably down about 25% at the lows, or a first quarter of 2020, that you want to be in position. Doesn't mean you're not going to lose money, but you want to be in a position that you are re-hedging, you are taking advantage of, you are playing offense, and not worrying, is my left tail okay? Do I need to scramble to do that? And that's, to be fair, that is an OConnor thing, to make sure that if you're long curve, you're long the curve where you want it, when you want it. And so we're very conservative in that way. It's one of the reasons why I think it's so incredible what's going on in some of the ARB spaces right now, is that you're able to hedge out so much of that exposure, whether it's using equity derivatives or shorting straight bonds, or even if you're going to do an overlay in a major ETF. Yet your returns are too high for a situation where you can take those risks off the table. Not only is your absolute number big, but then if you were to back that into a risk-adjusted number, it shouldn't look like it does right now. And I think along a lot of the arbitrage strategies, certainly the ones that we traffic in, you have a supply-demand balance that will be corrected over time, but without the banks being there to jump in and say, well, wait a minute, we should be moving into this, it takes a little bit longer, whether it's a new hedge fund launch or a hedge fund realizing it and going out and having raised money for it, or those types of things. And that should really be to the benefit to alternative investors.
You mentioned hedging, and so let's finish on that topic. A couple of hedges that were normally at your disposal in the markets are really feeling elusive. One is duration. Getting the bang for the buck there is going to be much more challenging than it's previously been. I'm not sure exactly where the 10-year is supposed to rally to, the next big risk off. So that's not as effective as it was. And then the second one is diversification. Things are incredibly correlated, whether it's across credit, certainly within the equity markets. Factor rotations can be violent and very correlated. So it's not obvious that you can just diversify your way into a lower risk profile either. And so I'm curious if you can just give us some of your perspective on tail risk hedging. That's been a topic that's gotten some attention the last year. It's costly sometimes, but sometimes it can really provide a tremendous offset to a portfolio that's quickly falling. How does that fit into your trade construction or your overall portfolio construction process?
Sure. So I think you're right. You watch the risk parity folks go from 60% equity and 40% fixed income in treasuries. And then when the 10-year traded 1%, you saw them roll into corporate credit. And then the Fed bought corporate credit. And really, there's not a lot they can do to diversify their way out of, or asset class diversification way out of it at this point in time. So some of our strategies don't require it. We think they have their own convexity. One of our strategies, our merger arbitrage strategy, definitely requires it because there is beta to the downside on you're waiting for deals to close. So we tend to try to keep it simple. The most efficient thing for us has been some type of put spreads. And usually it's well out of the money to keep that extreme left tail there. So we're not going to profit from those things in your normal, hey, we're down 3% and spreads widened by 40 basis point day. But should you have a situation like you had in some of these really rough markets, that's going to be there to try to buffer you. We tend to keep it simple.
Yeah, I think the listed market is simple and transparent. And I've always had the view that, especially in hedging, if you've got something that you need as an offset, you might need to monetize it very quickly, and better to have something that's liquid and fungible and not something that's too complicated that you can't unwind quickly and efficiently.
Yeah, well, we definitely agree with that. If you can't describe what you own in a couple of sentences, it's probably not worth it.
Well, Mark, it's been great to chat about your career and learn a little bit more about DLD's focus. And I want to thank you for being a guest today on the podcast.
Thanks for taking the time with me.
Thanks for listening to the Alpha Exchange. Before we go, I wanted to share with you an inspirational investment symposium I'm hosting on May 11th and 12th on behalf of MacroMinds, the foundation I launched in 2018 in order to raise money for nonprofits that focus on helping improve educational opportunities for children in the New York area. Our initiative is based on two primary ideas. First, educational shortfall for families is self-reinforcing. One statistic: the children of college-educated parents are 7 times as likely to go to college as are those whose parents did not finish high school. Working together, we can help push back against this cycle. The second idea behind MacroMinds is that the community of finance professionals is at its best when we engage together on the many difficult questions out there. Disinflation, crowded trades, monetary policy, cryptocurrencies, and the cost of hedging are just a few of these. Set against these uncertainties, what are the considerations most relevant to portfolio construction? What's the next big thing in finance and markets? On May 11th and 12th, these important topics will be explored. I couldn't be more excited to bring to you such accomplished market professionals who are offering their time and providing their insights. I hope that you will consider both attending and sponsoring the event. More on MacroMinds and the symposium can be found on our webpage, macrominds.org. On behalf of our partner charities, I sincerely thank you for your support.